Right now, Wall Street is making a fatal mistake on Google. The mainstream narrative is telling you that AI is about to completely cannibalize Google's search monopoly. They say that every time an AI answer pops up on your screen, a profitable ad click dies. Now, why would people pay for search anymore, like companies, right? But behind the scenes, this is how Google is quietly dominating the new global generative AI search, aka GEO, G-E-O. While retail investors see their favorite search engines quietly dying of a slow death in favor of new flashy AI models, Alphabet has just quietly raised its CapEx guidance for 2026 to a jaw-dropping $190 billion. That is no software budget. That is the budget of an industrial AI war machine. So look at this curve. It isn't linear. It's a vertical launch pad, and Alphabet is plowing nearly 20% of its total revenue back into physical, concrete, custom silicon, and power grids. If Google is about to lose its search revenue, why are they spending the GDP of a small European nation building physical infrastructure and doubling down on AI search? The answer is exactly why Google raised a DEFCON code red alert when OpenAI launched in 2022. We just got Google's Q1 2026 earnings numbers, and this is the exact moment that we can see 4 years of work paying off. Today, we're going to look past the superficial headlines and the AI bubble fears and break down the actual numbers to see if Google is truly worth 6.5% of the entire S&P 500. So let's start with this chart, the cannibalization myth. The bears screamed that AI overviews would decimate search revenues. Let's bust this myth wide open. In Q1 of 2026, Google's search didn't shrink. It actually grew by over 19% year over year, hitting over $60 billion in a single quarter. So where is the growth coming from? Because AI overviews aren't replacing searches, they're actually increasing search engagement. Users are no longer asking simple questions, they're asking complex questions that are more commercially valuable to companies. And the core ads that they're running are more profitable than ever. But here's the real growth engine behind Google, their Google Cloud. This segment just blasted past $20 billion in a quarterly run rate. But looking closer at Google's metrics, Google Enterprise AI solutions experienced an additional 800% revenue increase year over year. So Google Cloud plus Google AI equals high growth. This isn't speculative retail hype. Fortune 500 companies are locking in massive multi-year enterprise contracts. Google's cloud operating margins didn't compress under the weight of AI. They actually started expanding and hit nearly 38%. Now this is the final piece of the puzzle and why Google is more than search and an AI model. Competitors like OpenAI and Anthropic are renting cloud servers at massive markups. But Google is doing the exact opposite. They are designing their own custom chips. Because of this, Google cut their core AI response costs on every prompt by over 30% over the last year alone. They can run their models 25 times cheaper per token than their competitors OpenAI and Anthropic. It is a vertical integration advantage that is unique to Google and is quietly starving out the competition. So, of course, what is the case for the bears? Because this isn't just about who has the best algorithm. It is a battle over physical silicon. And right now, Google's total TPU custom chip production capacity is projected to hit 4.3 million units this year. And let's see where that capacity is coming from. Our research reveals that Google has actually expanded its chip production because Meta has decided to get out of the custom chip manufacturing game and allocate their demand directly to Google. Meta realized it is cheaper to secure TPU access from Google servers rather than build their own pipelines from scratch. So Google is slowly becoming the facto toll booth for the entire AI ecosystem. Even Anthropic, the creator of Claude, has committed to deploying over 1 million Google TPUs inside of Google's cloud infrastructure starting next year. So here's the catch that bears will bring up. This is a massive capital expense, and Google is consuming an enormous amount of their free cash flow, which has dropped over 46% just this year because of paying for upfront infrastructure costs related to these data centers. This is the classic J-curve, a huge capital pain today for an absolute margin monopoly tomorrow. And that is exactly where the retail playbook comes into play. First, the margin leverage long. If Google's internal chip program continues to lower their AI server costs, their margins will recover far faster than Wall Street expects. We are watching Alphabet, Arista Networks, and Vertiv, the primary liquid cooling suppliers for Google's new ultra-dense TPU V8 pods. Second, the grid lock-in. Google's biggest bottleneck is no longer chips. It is power. Building out $190 billion of physical infrastructure requires a massive grid connection. We are tracking General Electric, Vernova, Constellation Energy, and NextEra Energy as the silent winners of Google's power-hungry data center expansion. But there is one even larger problem that Google must solve. We can build out data centers locally in North America, which is happening right now. But in order to turn this into a global AI scale, it requires this one additional resource. So like and subscribe this video, ring the bell for our next video where we deep dive into deep sea fiber optic cables that are going to connect the world for AI.